So that's kind of the history there. But yeah, I mean, if you look at the chart, see the reason why I say that is not just because of the, the way the chart looks, right? Because this looks just like Tesla up to now, right? It's the same darn thing, but it's the reason Tesla is doing this and, having this exponential move, if you will. We look at the 5-year chart, right? Looks just like Keurig Green Mountain, right? Up to this magnificent move here, right? It looks identical. And now you have this shape right here, which looks identical to this, the start of this, right? Here's the thing with Keurig Green Mountain. We can look at the chart and say it's setting up the same way, right? But that doesn't really measure, that doesn't pass the smell test, if you will. The real thing is what's going on with the company. See, with Keurig Green Mountain back here, you had just exponential growth in distribution and production, sales, et cetera, et cetera. What you also had was a story. And who's better at painting a story than Elon Musk, right? The guy might as well just write books, nonfiction stories, if you will. But that's also what the former CEOs, I say CEOs because they went through more than one CEO during their publicly traded life cycle. That's what did this with Keurig Green Mountain back then. It was a narrative. It was a story about technologies, about sales growth for the future, so on and so on, until we got hit with an accounting scandal. You guys put that past Elon Musk? Really? Same guy that was smoking a joint, on a podcast? Same guy that, basically flaunts, the SEC rules and regulations? Now, I'm not saying there's going to be an accounting scandal. I'm just saying there's always something. After this, it could be anything, because this is excessive risk taking. This is pricing in the best of the world of the future for Keurig Green Mountain back then. You don't think the same thing is happening here? Like, this is pricing in perfection, personified perfection of everything in the Tesla business model. Everything has to go right. That's all I'm saying. This looks just like this. I don't care what caused this at this point. I'm not saying the same thing that caused this is going to be what causes price depreciation in shares of Tesla. Not saying that at all. I'm saying it could be anything. Why? Because this does not survive. These kind of moves don't survive. Ever. One of our members, gave us the opportunity, to look at a similar situation with, and most of you who are in the trading room with us, seen us look at the chart of Lending Club, right? This move here. And it's already doing this. Like, these moves do not survive. It hasn't had the same run, this is only basically, a year. And Lending Club is asking investors to accept, adopt, and invest in a different business model than when it came public with. All fine, well, and good. But this is now 3 examples I'm showing you of just parabolic moves that are not survivable. Ever. These don't last. It's why you take your profits. No, I don't care if no other, if it's not about it's not really about, I'm not saying Tesla's not survivable. Tesla's survivable. Tesla's going to do fine. But Tesla and the stock price are two different things. They're two different things. The stock price, remember, the market is a forward-looking discounting mechanism. That's why I say this is pricing in perfection, not just for 2021, but maybe for several years. You know, here was the move up to and through 2011. It took it came down, did nothing but make new lows through 2012. It didn't get back up to its former highs. Here's 2014, basically into the early part of 2014. So from mid 2011, took about, let's call it 2.5, 2.75 years. 2.75 years to get back to these levels. That's the problem with these exponential parabolic moves in stocks. They price in too much of a good thing. I don't know what's going to be, the undoing of this move here in Tesla. I don't know. And there's no guarantees that this is going to turn out like this. There's no guarantees. But I've never seen this survive. I've never seen it. In 22 years of investing, I've never seen it survive this kind of move without a substantial correction. It took years to get back and make new all-time highs here in 2015. And by the way, why did this happen again? Keep in mind, I was literally the axe in Keurig Green Mountain stock. I had the CEO of the company literally try to file a suit against the firm that I was working for because we were bearish on the company all through this move here. Why? Because back here, they were telling a story. Now, for a certain period of time, the fundamentals did align with the story the company was telling people. So you're okay. And the stock follows the story because the fundamentals are improving. Here, you basically from about here, this move to up here, nothing was working. The story was out there. The hope was there that the story would come true and give Keurig Green Mountain that next exponential growth factor, right? They partnered with Coca-Cola. They were going to make basically a Keurig cold sparkling beverage machine for your countertop. Now, I knew about this machine in development all the way back here because I studied patent filings. And they had this patent that was published back here in 2011, but they didn't announce the development of the product until 2014. Well, it was around here that they started to make what they call product development. Product development is not just development of the actual end product. It's about all the elements that go into making a product. It's supply lines, it's materials, it's engineering, it's payroll, it's R&D spending. That's product development. So they were telling a story here. And so while the existing business model, right, the coffee and K-cup business model was floundering, right? It started to show cracks. It started to show that two things were problematic. A, they had no expansion potential beyond the United States or North America. They tried to expand into Europe, but Europe has a different taste palette. They like a much richer coffee than we do in the United States. Like for some of you who live overseas or, have been in it's about that dark, espresso type of flavor that you really don't get the same thing here in a traditional coffee maker or a Keurig coffee maker. It's different. And then there's price point. Well, if it sells for this much in the United States, imagine how much it would have to sell for in Europe, right? Because you have a whole different dynamic. You have shipping costs, you have distributor costs. Now you have to share the profits per machine because you have to hire distributors in Europe. It went nowhere. They partnered with somebody in the UK. It literally went nowhere. So it was a story. You had Goldman Sachs, you had KeyBank raising their price targets when it was in the hundreds, low 100s, like 105, 100, raising their price targets to $150 and $175 a share. Meanwhile, bad things were happening right here, folks. And here I'm writing my reports every week to hedge funds, that subscribe to our research, and our clients were pissed off because we're bearish here. And the stock's going up to 150. This wasn't just a fall, folks. This was a disaster. Why? Because not only was the underlying business problematic at this time, they had saturated their distribution. Year over year sales were falling. They weren't just falling by 1% or 2%. We're talking double digits, which means earnings are falling. Oh, and by the way, they finally launched a webcast. They launched a webcast that demonstrated the new Keurig cold beverage system, for which Coca-Cola invested more than $1 billion in the company. They bought stock worth about $92 a share. Coca-Cola owned a stake in Keurig Green Mountain worth $92 a share. As soon as that webcast, in the after hours, it was in the after hour session, the webcast was going on. The stock was down 10%. Why? Because the cost of the machine was going to be $369. The cost for a pod of Coca-Cola, Diet Coca-Cola, Pepsi, Sprite, was going to be literally $1 to pour an 8-ounce glass. $1. The stock just tanked. It was down 15% within a week, 20% within a month. $150 a share. It dropped to just below $40 before it found its base. They told a good story. They told an even better story. This is the actual fundamentals of the company. That was the value. What was Coca-Cola supposed to do? They literally own Keurig Green Mountain for $92 a share. The stock is under 40, and there's nobody who wants to buy into this. No retailers would buy into the Keurig cold system. They had basically no orders. Within 6 months, Keurig cold was taken out of distribution and basically thrown in the trash heap. So what was Coca-Cola supposed to do? Are they supposed to take a write-off? And at this time, David Winters, which was an activist investor who was going at Coca-Cola, going at Mukhtar Kent because of the excessive, CEO bonus packages and executive packages, payroll, pay schedules and whatnot. There's no way Mukhtar Kent, the CEO at that time, could write this investment off. So what did they do? They decided to, partner with GMCR and say, you guys got to sell yourself. You can't stay public. You got to get out of here. And that's what they did. They sold themselves for how much? How much was Coca-Cola's dollar cost average in the investment? $92 a share. Go find the headline, folks. Go find the headline. If you want the most nefarious activity, in my opinion, in history, it was this. Keurig Green Mountain was acquired by JAG Holdings, a European company, for $92 a share. No SEC investigations. FTC allowed it to go through. 6 months later, Mukhtar Kent steps down as CEO of Coca-Cola. There's a good story being told here in Tesla. But these moves, they don't survive. Everything has to go right. And I'm not saying it won't. I'm just saying we're trading through a time period where excessive risk-taking, speculative trading, and investing activities have been rewarded. That is actually what tends to happen coming out of a recession and coming out of a bull market. You compound that when you have this much liquidity sloshing around, not just the United States, but the world. The world. Hopefully, this kind of opens some of our eyes to understanding that these moments don't last. They don't. They're rarely survivable. Something I tweeted out earlier. 2021 should, there's no guarantee, but should result in a leaning away from the speculative trade and in favor of the quality trade. It is going to prove difficult to find a reward for the same speculative trade from 2020 into and through 2021. We're not even going to have the same investor participation here this year, right? We're already seeing a lot of the retail trader activity unwind here through the first quarter of 2021. We have to adapt. We have to know what's going on and around the market. It's the big macro thesis I always talk about. Don't get to, tunnel vision. Got to avoid the tunnel vision. Have to recognize that we're adjusting from the high speculative trading period, to a mid-cycle period. The cycle may have sped up given the rapidity of the recession / bear market into a expansion cycle / bull market. Things are happening a lot faster because of all the liquidity, all the monetary and fiscal policies implemented around the world. We shouldn't just say, well, we're still in the early innings. We may not be as early as we think. Things may have sped up for this particular cycle. There's just no appetite for a bear market, for a recession at the political level anymore. And it all happened in an election year. Promises were made. Those promises, especially for a new president, they better deliver on it, or that new president is going to be met with probably an eviction notice, in year 4, come the next presidential election cycle. So just some, food for thought, if you will, food for thought. All right, and here we go. We've got futures now at their lows of the pre-market session here, rounding the bottom of the hour, 8:38 here. So we got some time, basically flat yesterday, right? Basically flat pretty much across the board. Just not a lot being done. Dan, be careful with that Keurig. I don't know if, see what a lot of people don't know about the Keurigs is you better clean them. And that descaler that you can buy for your Keurig machine, it only works basically for the reservoir and the outflowing tube. If you have never opened, if you've had your Keurig device and you're, an every morning coffee drinker and you've never opened the back of it to clean, quote unquote, the under the hood, don't throw it out. You will be disgusted by what you find. It'll probably make you vomit because there's usually spores, mold, bacteria just growing throughout the system there. So don't open it up. Just throw it out. Trust me. Again, and if you're looking for articles on Keurig, Seth Golden, Keurig Green Mountain, the stories I could tell you guys, just Google it. The stories I could tell you when I was covering that company as a sell-side analyst would blow your mind. And that's, again, going to the CEO level. There's a reason why the CEO tried to file a suit against Capital Ladder Advisory Group back then for basically my research. It's because he did something that he shouldn't have with an employee that we had proof of. I hinted at it in one of my articles a long time ago on Seeking Alpha. But I didn't want to, put the guy on Front Street in a more detailed way. But if you read the article and you hear what I just told you, you understand what he did with this particular employee at the time. But, we tend to think of these CEOs in these big conglomerates, Coca-Cola, Keurig, General Electric, Home Depot, blah, 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 as these, buttoned up, well thought, highly educated people that are impervious to fault. Folks, the things I've seen over my years, covering different companies, would blow your minds. And some of them eventually do come out, on TV and whatnot in the news cycle, but few and far between. We actually get to hear and know of as investors. So futures are lower, but who knows what's going to happen when the market actually opens. Looking at Amazon, it's actually, flat to bid here this morning. Almost the same thing here in Google. Apple's been holding its own as well here in the pre-market. This might be one of those large cap growth days, but again, we'll see. Semiconductors, after a really nice 3-day run, had a decent consolidation yesterday, but again, holding their own here in the pre-market on stocks. SMH, we'll see how that opens. Bid-ask spread's a bit wide there. Yesterday, a nice bid. We got above the 50-day moving average in the software industry ETF here. And then we pulled back late in the day pretty much with everything else. So kind of looking at some of the charts here this morning. We'll get into a lot of charts. A couple of things I do want to highlight, though. Also, I put out there on Twitter. Remember, just the previous day, or on Monday, we got up to 79.20 on the bullish percent S&P 500 index, which was the highest level since basically the election. Checking in on it today. Checking in on it today, even with the market down yesterday, it rose to 81.80. This is the highest level it's been since way back, because this is higher than right here. Excuse me. So markets down across the board yesterday, modestly. We're talking about 3-4 points on the S&P 500, but the bullish percent index continued to rise there. It also came with the advanced decline line getting to a new high for the S&P 500. As you can see here, S&P 500 advanced decline line, a new high. What do we know about the advanced decline line getting it to a new high? Usually breadth leads price. Look at the MACD down here, folks. Now, I'm not saying that, we can't consolidate price more. We can't go lower. This is more of a know what to do. Know what to do if we do see price consolidate further on the S&P 500. All-time highs hit again yesterday. I think this is the 18th new high on the S&P 500 already in 2021. 18th, I think. Know what to do when the market weakens. Breath tells us the participation is still there. The strength of the market, the underlying strength is still there. RSI is a little hot, right? For this particular breath indicator. RSI is pretty hot, above 71. Tends to elicit, overextended markets, if you will. A couple others, let's see what we got. NAMO yesterday, I think this one fell a little bit. This is the NASDAQ McClellan oscillator. Yeah, just a little bit of a hook down there. The good news, though, as we talked about yesterday, was this actually got above this prior, slightly, but it did get above this prior high. We're kind of tired of making these, lower highs as we have been making. So to get a higher high than here is good stuff. We want some follow through, obviously, to kind of curl up once again, but day by day, of course. The technicals tell us what happened, what is developing. They're not predictors of the future. Wish they were. Anybody have that prediction of the future, please put it in the chat box. All right, here's also, pretty much the same thing, the bullish percent index for the NASDAQ, as opposed to the S&P 500, which we just looked at. And that went a little bit higher as well. We still have a series of lower highs here, though. So we need to get above this mark here, which would be nice. NYSI, McClellan, New York Stock Exchange, McClellan, that continued to go higher yesterday from 550 to 564. So again, even though markets were down modestly, breadth was pretty decent enough to continue to see a rise here in the New York Stock Exchange, McClellan Summation Index. Again, another breadth indicator measuring advancers versus decliners. So pretty much all of these look reasonably good, still in good shape. Any consolidation we see should be deemed as opportunity. And some other breadth metrics looking underneath the hood of our major indices, a little bit of a pullback here in the percentage of NASDAQ 100 stocks trading above their 50-day moving average. But we spent a goodly amount of time with less than 50% of them above their 50-day moving average, and now getting back to and above and holding above 50%. We're at good levels. We've seen the NASDAQ now 3 days in a row close above its 50-day moving average. Again, what we really want to see is, that much more upside here. These are the Qs. Let's see what we got here on the Qs. Qs look really good. They're setting up a bullish pattern here, kind of a W. It is a W, but next line in the sand really is all-time highs. We can look at Fibonacci levels, and we're pretty much above, the Fibonacci retracement, all the Fibonacci retracement levels. So that doesn't really, make a whole lot of sense to do that exercise. And nicely above, the 50. Well, let's look at one. I want to look at the day. Okay, there we go. That's better. Looks it's a raggedy W, but still a W. So nicely above the 50-day moving average here. And really, the only thing that's left is to make new all-time highs on QQQ. We talked about the semiconductors and kind of needing them to pick up the pace and get above their 50-day moving average, and they have in a material way, right? Yesterday, high of the day, 257.54, 257.54, which is just under the former high here, 258.59. Again, there's nothing left here with the semiconductors other than all-time highs. Now, for those of you, you may have caught this statistic I threw out there in the recent forum activity this morning, homepage at phenomgroup.com. And you can see here the narrative around it. Okay, that's not working for us. All right, let's see. There we go. Monday's gain for the stocks or semiconductors adds to a 9.5% gain for the index last week. As shown in the chart below, that 9.5% rally is historically large, especially relative to the past several years. So some examples in here of when it has happened. It happened last year, March 15th. It's basically, you're in the 95 percentile. These rallies are in the 95 percentile or better of such moves. Prior to last year and more, this recent rally into the 95 percentile of rallies, it had only happened in the late 1990s and early 2000s. Now, when it happens, here's the forward-looking returns for the semiconductors. A week later, not that great. 2 weeks later, not that great. A month later, and their positivity rate, right? Positive 55% of the time, positive 60% of the time 3 months later. So we've seen this strength, but the strength may lead to some consolidation here. We'll see if this time is a little bit different. And so maybe we do check back a bit, visit some support levels down here maybe. I'm of the opinion, though, going through earnings season, and I think that's why we found this strength and now are trading nicely above the 50-day moving average, is because of earnings season, upcoming earnings season. We have a lot of analysts upgrading some of the individual semiconductor names as well as the whole of the sector. We know that there's supply restraints. We know that prices are going higher for semiconductors and DRAM prices. And I think that's reflected here. It's anticipation of improving gross margins and just the general demand side of the equation. It's a good problem to have. Too much demand on too few supply. Software, another story. Again, yesterday we got above the 50-day moving average on the software industry sector ETF. We got above it. Unfortunately, and we closed above it, even if just by fraction. As you can see here in the chart, it's by a fraction, but we did close above it. In terms of the QQQ, in terms of tech, right, the XLK, the technology sector ETF, XLK, we need not just semiconductors, but some of the other tech industry sectors or industries to come alive. Software is one of the other bigger ones within the technology sector. So this one closing above the 50-day moving average yesterday is another healthy development. We want follow through, right? I mean, that's what it comes down to. We want some follow through. We got back above here, right? We had kind of a really steep fall, and then you get a reflexive bounce, but then that reflexive bounce usually fades. And then we have more of a material correction, but we are above this lower low, which is good news. And again, closing above 50-day moving average. What we want to do is have multiple closes, just like the NASDAQ, above the 50-day moving average. Multiple closes, just like the semiconductors, above the 50-day moving average. Follow through. Need follow through. RSI looks good as well here at the bottom. So underlying strength, relative strength possibly will give us that follow through that we're looking for. Do I need to go into the Dow Jones Transports? This is another hyperbolic move here, right? Parabolic. Why do I keep saying hyperbolic? I don't know. RSI is at 70 though. And look at the distance between price and the 50-day moving average on the Dow Jones transports, right? This is another, usually you get some kind of consolidation when you're, 2 to 3 standard deviations above the 50-day moving average, like we are now here on the Dow Jones transports. But again, this trend is your friend long term. If you're looking at FedEx, if you're looking at UPS, it's probably a good opportunity if this weakens, consolidates near term, to buy on that weakness. But looks good. I run reverse osmosis through it. Gotcha. All right. Again, let's look in. Nike suspends endorsement of, oh yeah, that's Sports Center all day, every day right now. Now, the 10-year yield had been down the equivalent of what we see it up right now. It had been down almost 1.5 basis points. Now it's up 1.5 basis points. Yesterday, we had a really nice move lower in bond yields, a nice move higher in bond prices. So we'll see. Long day ahead. We'll see if these gains in yields, losses in price are sustained throughout the session here. We're now at the lows on the NASDAQ, and we've typically have seen weakness in tech names in the NASDAQ as a whole. Excuse me, when we do see yields, rising somewhat, but we'll see. Never know. Yesterday, the dollar had a nice pullback here this morning. It was down about 10 cents. Now it's unchanged. Again, yesterday morning, we had Goldman Sachs basically, cover their short in terms of sentiment and their recommendation on the dollar. And they think it'll, now has some appreciation. But the dollar was nicely over 93. We have this pullback here. We'll keep an eye on what happens to the dollar as we, look at all of our various asset classes throughout the course of the day. But it was down 10, so it has rallied along with yields. Gold was lower. It's still lower, about $6 a troy ounce. Oil was up 50 cents, still up about 50 cents right now. And Bitcoin down another 16. It was down yesterday, 1,600 here this morning. Europe right now, lows of the session. They've been edging lower as our futures have been edging lower. DAX down about 0.25%, same as Stock 600. Asia overnight opened up again here, pulled back about 1% there on the Hang Seng. Ooh, slight rebound there on the Nikkei from the previous session. Kospi up 0.33. All right. So as I said before, when we first started, looking at the VIX and the pre-market, that dip down almost a full percentage point was not actual transactions. It was just options chains expiring. And you can tell if you just go to VIX futures, and you saw that, VIX futures did not respond at all to that VIX move lower in the pre-market, telling you that that's just option chains expiring. And now we're slightly higher across the board here on all monthly VIX future contracts. So we have been holding above 10% contango on the front month, 5% on the back month, and pretty much not much has changed there. We got about $1.50 roll yield. Started yesterday, $1.70 roll yield, moderated throughout the trading day, but we're still, in this $1.20 to $1.80 roll yield zone. And, now we only have 13 calendar days left in the April VIX futures contract here with that much roll yield. And that's still a healthy roll yield, folks. We're about 60-40 now in terms of assets under management for your VIX exchange traded products like UVXY or VXX. It's about 60-40. They're more heavily leveraged to the May futures contract at this point. Every day they're selling the April and they're buying the back month futures contract until everything is out of the fund or the note and in the back month by expiration date on what's that, 420. Everything seems to be 420 lately. We're hearing way too much of 420 lately, I think. Speaking of Tesla this morning, right? Okay, well, don't need you. Go away. Okay. We'll get to a lot of our videos today. Some good ones, some more on QQQ from, a third party perspective, because it's one thing for me to, look at the Qs and, offer my expectations and what I see going on. It's sometimes a good idea to get a third party's perspective. So we'll check out this video here in a little bit related to QQQs from Leslie. I don't want to butcher her last name, but we'll check that out later. In terms of pro shares, we'll go to the site just to make sure we're on schedule with, the daily changes in assets under management. Yep. This is still moving lower. It was 36,000, I think, just yesterday. Now 33,000 on the April futures contract. The May futures, almost 47,000. All right. So in terms of trades, yesterday, nicely done with respect to our entry into Alibaba shares. We got in at 226, we'll call it. It's 225.90, but I'm not going to split hairs. We sold a quarter of the position basically to pay for the trade. I mean, it went all the way up and above 231 yesterday, closed at 230.57, back under pretty good pressure here this morning. But the quarter position that we sold yesterday to pay for the trade, right? We got in at 225.90, went all the way up to 231.30, where we sold a quarter position. In the pre-market, we were able to get that back at 227.08. And we're still up overall on the trade. So some good pressure coming back into the stock. We've talked about this. Yes, Charlie Munger, whatever. It's good to have a name like that, kind of taking a significant position in the stock. But Alibaba has shown fits and starts in the past. It's shown these tendencies to, rally and consolidate and then all of a sudden fall off the cliff once again. So a nice rally on the headline yesterday, Charlie Munger, but here we go, consolidating once again. What we want to see is follow through. We want to get to like $240 a share without these continuous, pullbacks from, one-day rallies, if you will. So far, we haven't seen that. It could change, and in the pre-market, it is what it is. But it's the opportunity, that we want. We want to be able to sell at a higher price and recapture those shares at a lower price. Not gonna, we shouldn't be too terribly nitpicky about, well, maybe we can get it a little bit cheaper. Look, $4 lower than where we sold yesterday. Take it. What else do we got going? TQQQ this morning. All right, so we may get our opportunity here as well to recapture, a first trading position. Keeping in mind our dollar cost average on, I think we've done a good 15 trades in TQQ from, the high 60s all the way up to 100. Our dollar cost average is right around $62. I mean, we want to get, back on the board here with the first position. Game plan, to build upwards of 3 trading positions around that core holding that we developed, through those 15 or so trades in the past. Semiconductors, again, we'll keep an eye on that and software. We want to see strength there, but, that's another one. You got to think about buying semis. In my opinion, you got to think about buying the weakness in semis. Unless something is going to go materially wrong in the reopening, global or domestic, semis have a long runway of growth and profits ahead. Historically, any weakness in semis has been a buying opportunity. Why should now be anything different? Has something changed? Has something dynamically changed in the macro outlook? No. I mean, the IMF just yesterday or this morning, I think, raising their global GDP forecast once again. That's not a bad thing. So I think any weakness from here should be used to, if you're looking for additional market exposure, if you're looking to broaden out your portfolio, diversify your portfolio, I think that the semis going to be a good way to do it. Yeah, Rob, I know you love those. Good times, absolutely. And I'll get a trade out there. I'd like to see it dip under 100. That would be great. Can't time everything. Again, it's about opportunity. If we're patient enough, the opportunity develops. TQQQ got up above $103 yesterday before pulling all the way back and finishing at 101.42 and now down here. So, we had order out there, but it just didn't materialize. We were low. We were too low on the day yesterday, but we didn't, I didn't push up the order simply because, patience, and we had allocated cash out elsewhere. Nice short yesterday, also in Kohl's. We did very well with that short. It happened actually quicker than we expected. Took our profit, $61.31. We covered it under $61, and it finished at 60 on the nose. It's got a wide bid-ask spread, but based on what we see here in Macy's, here in Target, Bed Bath. I mean, these are holding in the pre-market despite some of the mild weakness in futures. There may be a bid again here in these kind of retail names today. So we could get back up into 61s easily on Kohl's today. Headlines this morning on Beyond Meat as well. We've been patient with this one. I said, there's a possibility this could get into the 140s. That's a better risk reward. They announced that they're setting up, I guess, some kind of production facility in China. So the stock is bid up here this morning nicely. Now, when this one gets bid up, a lot of times it does run over shorts. It can be up 15% or so in one trading session. We've seen that time and time again. But lately on headlines, it hasn't performed like it has in the past. It's actually, it starts out well, but then fades through much of the day, even on these proposed positive headlines. I think that speaks to participation in the stock, maybe even just the general market, losing some of those retail traders, those Momo traders, those short squeeze traders that are, follow those high short interest stocks. I think that's dissipating, and I think that's hindering, some of these headline day moves in Beyond Meat. But from a risk reward standpoint, a starter short position in 140 is ideal. Beyond that, you assess your own risk appetite. The best way to, obviously layer in a position would be to keep it small. Fundamentals for this company, go look at the quarterly results. They speak for themselves. Every single quarter since this company has come public has demonstrated this is nothing more than a CPG company, a consumer packaged goods company, not unlike any other out there. But this is the unicorn of that particular IPO cycle. It has a very small float, and I think that is what has kept this valuation alive. It has a much smaller float than some of its counterparts that IPO'd around that same time, 2 years ago. Still has a high short interest, but I would be looking to, short this today. Probably doing my risk position. If it gets up into the 140s, I would look to, initiate an official trade alert out there short. Amazon still holding its own in the pre-market. Google holding its own. Futures haven't budged all that much here. Nice run yesterday on Twitter. Pulling back a little bit here in the pre-market, but we'll see. Below 126 here. And we may be able to get our second position on again here. We'll see. Any headlines on Apple this morning? Wall Street bet stuff. Nobody cares. Tesla, again, could not finish above 700. It's a problem. I'm sorry, but it is. It's a key level. At this point, it's a key level. It's got to finish above 700, or you have to expect additional weakness. Facebook, I think Facebook is going to 310. I think, that all-time high over here. I think this is any pullbacks in Facebook at this point, just like Google, I think are buying opportunities that you just take small positions first, such that you can add, if it goes that much lower and breaks below 300. There's a good probability that you do get a revisitation below 300 as well. Earnings season ahead. Keep that in mind. That's part of your, risk assessment, risk management, knowing that it's probably going to have a decent size move, $10 to $20 on earnings, 428 end of the month, basically, and kind of looking at that calendar. Yep. Same day as Apple. So Facebook, Apple reporting on the same day again. Where is Google? I don't think that report earnings, 427 and 429 for Amazon. So back to back to back to back. It's usually the way it works. The first of that whole FANG cohort is on 420 with Netflix. Boeing, which we own, doing quite well. A little slight pullback yesterday, also reporting on 428, but that's before the market opens. What do you want to do? This is another one where, look, we've owned it since $168 a share. We took profits at this level previously on a portion, and then we recaptured them at $245. And then it's run up another $10. Again, sell at higher prices. Nothing's changed but the price. Nothing has, deteriorated in terms of the fundamentals. Buy it back. We've run that same price range now twice, with the same allotment of shares. It's fantastic. Look for those opportunities. If nothing changes but price, and it kind of this was our price target. This was our target, the 250s. But I've always said, more than likely, Boeing will outperform our price target. When we entered at 168, our price target was 250s over the next 9 to 12 months. It got there in about 6 months. It outperformed, but I stuck to the discipline, said, 250s, that's where we're going to sell some, sold some, and bought it back. Now, if you got, if some of us are in that same position and you got the substantial profit, and I know some of you actually bought below our 168. This might be the time heading into earnings that you start your game plan. What do you want to do with this substantial gain? Like, have a plan. Set expectations. Because we don't know. It might pull back $20. It might go back up to the, the high here recently at 278, which is not the all-time high. It was above $300, folks, 2 years ago. Got to have a game plan. All right, getting closer. Another leg higher here in the pre-market on Beyond Meat. Looking good. All right, so the setups for today, hopefully, in terms of trades, not much going on here still, just kind of ping-ponging between the lows and 520s here in UVXY. So it's not, high priority right now. But, we'll see what happens with Kohl's if that gives us an opportunity. Beyond Meat, if that gives us an opportunity. Would love to see some follow through off of yesterday headline in Walmart to possibly get, this week 142s, 143s. We have a second position. We've been holding since February 18th in Walmart at 140.18. So it would be great if we could take our profit from that one and have some of that extra cash as we start earning season next week. Next week, we've got big money center banks. And with yields higher this morning, big money center banks, they have got a slight bid here, right? JP Morgan, a couple pennies there. Goldman Sachs is actually, bid ask is too wide. A couple pennies here in Bank of America. Citigroup, flat to slightly higher on the ask. So big money center banks responding to yields being a little bit higher here this morning. But on the 14th, next week, Wednesday, right? 7 days from now, next week, Wednesday, we get JP Morgan, Wells Fargo, and Goldman Sachs. Ex-dividend day here today also for those of us who own Verizon. We're going to collect 63 cents a share, right? Getting paid to hold this one has been a joy. Really strong dollar cost average in Verizon in the Golden Capital portfolio. And we've been able to take, positions down. We had trading positions, 3 trading positions. We only have 1 trading position left, and that's actually a little bit above $61. So it's got a ways to go before it gets there. But again, we're getting paid 63 cents every quarter to hold this stock as a core in the Golden Capital portfolio. There might be another opportunity here to put on a second position once again if it consolidates. Our earnings are going to be out on the 21st. For Verizon as well. So a lot to think about as we head into earnings season, folks. And futures are getting a little bit better here, especially on the NASDAQ. So let's take one last check. Let's quickly, let me get this off the board for now. Let's go see what's going on with, if it's updated. We got down to 325. Don't think that's today. Yeah, that's not to the latest update. So high yield credit spreads. Again, this is the lowest level, 325, or the tightest spread that we've had in high yield credit since the pandemic began. This is the tightest level. So we'll see what this updates a little bit later. 10-year yield curve now. So we got up to 156, a little bit of flattening as the 10-year moves that much quicker than the 2-year. So the spread between the 10-year and 2-year now, 151 versus 156 just the other day. But again, we're still at levels that we haven't seen since 2015. Very steep yield curve, really good for the big money center banks and regional banks in terms of their net interest profit margins per loan. Speaking of loans, we got the mortgage data, I believe, out this morning. Both declined on a week-over-week basis, I believe. But there we go. What we care about mostly is the year-over-year. Mortgage refinance demand drops 20% as rates rise to a 10-month high. So the 30-year fixed rate mortgage has been rising, but it's still below 3%. I think the all-time low, which was, basically at the very beginning of this year, was 2.65% on a 30-year fixed rate mortgage. So if you have to add prime to that as well. And so now we're at 3.36 versus 3.33. What we use is the this right here, though. This is the where the start is of the 30-year fixed rate mortgage. So we are actually above, my bad, slightly above 3% now from the all-time low here. If we look at the 1 year, 2.65. So as the 10-year yield's been rising, mortgage rates have been rising. Kind of go hand in hand. All right, let's see what the year over year. Overall mortgage application volume down 5% on a week over week basis. It was 20% lower. For refinances, this is to be expected. Remember, the last 2 years, we basically had triple-digit growth in refinance activity as the mortgage rates were declining. But now as they're ascending, people have already refinanced. The pool of refinancing, folks, is very thin at this point, and those, have already done so below where we are today on the 30-year fixed rate. But mortgage applications to purchase a home fell 5%. This is a week over week, but they were 51% higher than a year over year basis. That's what we care about. Mortgage applications to buy a home up 51% year over year. This is obviously going to be a tough comp. So this is probably going to have this same type of, week over week result going forward. But the year over year tells us what we already know is happening in the housing sector of the economy, right? New home sales, pending home sales, construction, building permits, existing home sales. Like, there's just not enough inventory out there. There's buyers, clearly, not enough inventory out there. Housing market is still in great shape. Although it's hard for me to sell right now because I think home prices are going to continue to be strong and show year over year growth throughout 2021 and into 2022. I think that the people that are selling right now, they're going to do well, obviously. But I think that they're leaving some money on the table, so to speak. I think people are, seeing the home price appreciation now reach the double digits on a year over year basis. I think they're seeing that number and saying that they can't resist. I can't blame them, of course. Bond yields now, all right, so they've eased back down. We were up 1.5 basis points there on the 10-year. Now we're up a half basis point. Europe has gotten a little bit worse. Now down 0.3 and 3/10 over in the stock 600. Oil, that gave up almost all the gains. It was up 50 cents a barrel, now only up 3 cents. Gold hasn't done anything. Crypto was down 1,600, still down 1,600. The dollar's probably around, it's up a penny now on the dollar index. But again, it was down 10 cents. And that's all she wrote, folks. We got about 9 minutes now until the market opens.